Okay, so everyone, good afternoon again. I'm Joey Barnes, the Small Business Lending Manager at VCC. We would like to thank you for joining today and hope you'll find the presentation informative and helpful. Today, we'll discuss the Small Business Administration 504 loan program. This loan product offers a low down payment with equity injections as low as 10%, some fees financed into the loan, and the SBA/CDC portion has long-term fixed rates with a fully amortizing loan and no balloon. Our panelists will give additional features and benefits, as well as an example of how the product works. I have a few more items to note before we get started. First, today's webinar is being recorded. We'll be sending a follow-up email to everyone who registered next week and a link to the recorded workshop to be included. Second, if you'd like to ask our panel a question during the webinar, please use the Q&A function and not the chat. The Q&A feature can be found on the Zoom bar at the bottom of your screen. Questions submitted to the chat will not be answered. Our moderator will monitor the Q&A box and address questions at the end of the presentation. Please note all attendees have been muted. As I said a little earlier, I'm Joey Barnes, Small Business Lending Manager at VCC. I'm responsible for small business lending throughout the state. I work with a team of 3 small business loan officers who are housed in the Christiansburg, Richmond, and Norfolk office. VCC is a CDFI that was founded in 2006 with seed investment from the governor, then Governor Mark Warner, and the Commonwealth of Virginia. And VCC Bank launched shortly after in 2008 with a mission to get capital into the Virginia communities. We have 2 buckets of loan funds. One is for real estate, which includes multifamily, low-income housing, and we can bridge historic and low-income housing tax credits. The second bucket is for small business loans. We are a preferred SBA lender, which means we can process those requests quicker and easier than a lot of other institutions. We also lend to nonprofits. Our small business loans range from $150,000 up to $7.5 million. The funds can be used for owner-occupied commercial real estate purchases, equipment purchase, debt refinancing, working capital lines of credit, and new construction. We also do business expansion loans. VCC works with certified development corporations, better known as CDCs, to help business owners with the 504 loan product. We've invited 2 gentlemen who are very familiar with VCC and currently work at 504 Capital Corporation to share an example, discuss how the product works, and answer any questions you might have. First, we have Zachary Petry. Zachary joined 504 Capital Corporation as a business development officer in May of 2020. He has 9 years of SBA and small business lending experience. Zachary started as a micro lender serving startup businesses in Oakland, California, before joining a community bank in San Francisco as a C&I lender working conventional and government guaranteed loan requests for small business clients. Zachary moved back to his hometown of Richmond, Virginia, where he built and managed VCC small business lending and SBA programs before taking on a new challenge at 504 Capital. Next, we have Chris Topping. Chris is a business development officer at 504 Capital Corporation as well, where he partners with banks to help finance commercial real estate and equipment for small business owners across Virginia, North Carolina, and Maryland using the SBA 504 loan program. Prior to joining 504 Capital, he worked for 3 years at Virginia Community Capital as a small business loan officer, where he primarily used the SBA 7A loan program to help businesses obtain financing. One thing that makes them both great partners is that they not only understand the SBA products, but they understand VCC as well. And please remember, we want you in the audience to put your questions in the Q&A. We'll answer all questions, or as many as we can get to, at the end of the presentation. Zachary and Chris, the floor is yours.
Good afternoon, everyone. Next slide, please. I'm Chris Topping, and it's great to be here with everyone virtually today. Thank you for the introduction, Joey. Again, I'm a business development officer in the Hampton Roads region with 504 Capital, and formerly did work at Virginia Community Capital. So we thought we would go a little bit non-traditional today, and rather than giving a case study at the end of the presentation, we thought we would start off with an example of how the program works in a real life case study that both 504 Capital and Virginia Community Capital were involved with. And then we can kind of back into the product and how it all worked. Next slide, one more time, please. So I'll talk just briefly about a business in Norfolk off of Sewells Point Road known as the Syndic Climbing Gym. This was a partnership, a 504 loan partnership between VCC and 504 Capital. And the climbing gym actually opened right before the pandemic, so February or March of last year. And fortunately, they're doing great now. This was a really good fit for a 504 loan because it involved ground up construction and equipment to piece the gym together. And being a brand new business, a startup, would have been a little bit too much exposure and too much risk for VCC to do on their own as an 80% financed project or something like that. It would have been a little bit too risky. The way the 504 program and 504 Capital partnered with VCC is that in the 504 program, the SBA shares some of that risk with the bank. And so what happens is it's a partnership loan where VCC financed 50% of the project. 504 Capital, which is the SBA piece of the project, financed 35%. And then our client only had to bring 15%, which is a very low equity requirement on a large startup business project like this. So our client was able to keep a lot of cash to help with operating capital because they only had to bring 15%. VCC was able to do this construction loan where they only funded 15% loan to value of the appraised value of the property. And they have a first position on the collateral. So it's a much safer position for the bank to be in than if they financed the entire project. And it allowed a fantastic mission-based City of Norfolk supported project to get funded where over 15 jobs had been created. And it allowed a piece of land that had been owned by the city for 2 decades, I believe, to finally be utilized. And so it was really good for that community. And so the city of Norfolk and the Economic Development Authority there supported the project and also partnered with both 504 Capital and VCC. And so this is just kind of an example of a great project that may not have gotten done without the partnership of the 504 program, because as many of you on today are business owners, you understand that it's difficult to get startup financing or financing for a younger business. So we wanted to touch on this example of a really cool project before we got into the nuts and bolts of how to make it work. And then I'll also just say, if any of y'all are in the Norfolk area or want to come down, go visit the Syndic Climbing Gym. Zachary and I have been. It's a lot of fun, and it's a great, very difficult workout, but fun. So go check them out and support them. And I'll turn it to you, Zachary.
All right, thank you, Chris. Thank you, Joey and VCC for having us. As Chris mentioned, we have a close connection with VCC. So it's good to connect with our brothers and sisters over there today. Miss working with y'all, but glad that we still get to collaborate on helping small businesses together. So as Chris mentioned, he's in the Tidewater area. I'm out of our Richmond office. And here's a little map showing our coverage area. I looked at the attendee list for today's webinar and noticed that I think pretty much everyone attending is within this footprint. And so 504 Capital was Tidewater Business Finance Corporation, which some of y'all may be familiar with. We started in 1983, and it wasn't until recently that we expanded out of the Tidewater area. And being that our name was a little limiting, geographically specific, we expanded it to 504 Capital, or changed the name to 504 Capital so that we could expand into surrounding states and counties And so it was a few years ago that we were licensed to do 504 loans, not only in Virginia, but also in North Carolina, West Virginia, DC, Maryland, and then those highlighted counties in Pennsylvania, you see those are our rural counties that we're able to do 504 loans in. The majority of our loans, being that we've been in Virginia since '83, are in Virginia. We are getting more and more of a footprint in North Carolina, DC, Maryland, and some in West Virginia as well. So next slide, please. Thank you. So as mentioned, was formerly Tidewater Business Finance Corp, founded in '83. We've been around a long time, a lot of experience within the company. We are a CDC. That stands for Certified Development Corporation, not Center for Disease Control, which is a shared acronym we have. Certified Development Corporation, we're one of three covering the Commonwealth. You may be familiar with Redco and Business Finance Group, also two good CDCs. The way that the CDC structure works is we are licensed by the SBA to be authorized to do 504 lending, working with banks and borrowers to get these in place. Only these nonprofit structured CDCs are permitted to work with the SBA in this way to get the 504 guarantee in place. And since being founded, we've loaned over $350 million in 504 debentures and assisted over 500 small businesses. Next slide, please. Thank you. So the 504 program itself, you may be surprised to learn, has been around since '58. So it's pretty seasoned. It's had a lot of changes and kind of different iterations, and policies and guidelines are constantly updated. And this year is no exception, given the impact of COVID and trying to manage that. The main purpose of the 504 loan program, the majority of the loans, the vast majority of the loans are for owner-occupied commercial real estate. And you can see a little footnote there. Owner-occupied here is defined as at least 51% of the total square footage needs to be occupied by the borrowing business. And this commercial real estate can be, or the financing of commercial real estate can be for acquisitions, it can be for ground up construction, it can be for improvements on an existing building, or it can be for refinancing. Refinancing just the straight loan itself, or refinancing the loan with expansion, which is construction, building out on that property. That refinancing can also include cash out, which I'll go over a little bit more later, but that's been a very popular purpose for the 504 loans this past year as businesses have needed working capital. You can also use the 504 program for equipment purchase or refinancing. This is for kind of heavy equipment. It's not applicable towards rolling stock equipment or equipment that's registered with the DMV. So anything that has a license plate is not going to be eligible. Thinking more heavy equipment, machinery, assembly lines, things like that, mostly for manufacturing. Anything that's a relatively expensive piece of equipment that has a useful life of at least 10 years could potentially be financed by 504. Okay, next slide, please. Thank you. All right, so here are the highlights. These are the reasons why people turn to 504, and this is really kind of the bullet of, you know, if you pull nothing away from what is the 504 useful for, just maintaining or remembering a couple of these. These are the main reasons why 504s become so popular among borrowers and among banks. So from the borrower's perspective, the big thing is that it requires as little as 10% down. Actually, the first three bullets are probably the main reason why folks seek out the 504 product. It can require as little as 10% down. That includes financing of soft costs, closing costs, things like that. So the total project cost can include everything that you have to pay for that financing to occur. The second bullet is a very popular one as well. Usually the 504 rates are 1 to 2 percentage points lower than the market rate. And so an example of this is, as of our July rates are at 2.81%. The third bullet, those are fixed for 25 years. So there is no balloon payment. There is no maturity prior to the end of the amortization. It's 25 years fixed, one and done, fix it, forget about it. Principal and interest payments stay the same for the life of that loan. And so that's another very popular reason for the 504. Now it's just on the 504 portion. And we'll go over the structure of how these are set up with the bank and with the CDC lender. There's also an added benefit as of late from the CARES Act. The 504 program has benefited from a financial incentive that fees are being waived. The majority of fees are being waived. About 2/3 of the SBA fees that the borrower would typically pay are being waived, as well as 3 months principal and interest are being paid on the behalf of the borrower by the SBA. So it's not that they are deferred, it's that they are actually making payments on behalf of the borrower up to $9,000 per loan per month. And that's just on the 504 piece. That's not on the bank's first deed of trust piece. Now, I will put the disclaimer there that that's pending fund availability through the end of September. The SBA has been experiencing very heavy demand, and so processing times are lagging. So we are pretty much hitting that that kind of drop dead period to access those benefits. I would say applications that are not getting in to the CDC in the next week or two will not be hitting those deadlines to reach those benefits. However, regardless of those benefits, even when those benefits were not in place, the 504 product was still the best product out there that you could get for owner-occupied commercial real estate. So the benefits to the bank, and what's good for the bank is good for the borrower. 50% loan to value on the owner-occupied commercial real estate can allow the bank to do a deal that they otherwise may not have gotten comfortable with. Chris gave the example of the loan that VCC did with 504, Senate Climbing Gym. Given that it was a startup, it probably is not a loan that any bank would have done conventionally. And so if not for 504, that loan may not have been done. And so I kind of want to touch on the structure as I'm talking about 50% loan to value. Some of you may be asking, okay, well, where's the rest of it come in? So can we go to the next slide? I'll show the breakdown. Thank you. Okay, so this is the typical structure of a 504. You have, so that pie represents 100% of the total project cost. That includes closing costs, soft costs, any costs associated with that project. The bank is going to cover 50% of that loan, of that project cost. So they'll have a 50% loan to value, and they will take a first deed of trust on that property. The 504 piece will be 40% of that loan to value on that property, with a second deed of trust collateralizing their loan, and the borrower would typically come with 10%. Now, the only variation to this structure is, well, there's two variations. If a borrower has been in business less than 2 years, or I should be more specific, if they've been generating revenue less than 2 years, you could have been registered as an LLC for 2 years, but if you haven't been generating revenue for 2 years, the SBA is going to require you to add an additional 5% to that 10%. And then the other caveat is that if the building being purchased, commercial real estate being purchased or constructed is special use, examples of special use would be hotels, gas stations. Kind of, if you think about it, anything that would require extensive improvements in order to change the intended use of that property, that is going to require an additional 5%. So, and that eats into the 504 loan amount. So in this example, let's say it's been, the borrower has been generating revenue less than 2 years and is also buying a special use property. They're going to have to come with 20% down. The 504 loan will be 30% and the bank will still be 50%. Okay. Can we go back to the last slide, please? Thank you. All right, so the second bullet for the benefits to the banks. As I mentioned before, it's been heavily used the past year for refinancing, and that can be with or without expansion. Maybe banks have existing borrowers on their in their portfolio of industries that they're maybe not super comfortable with, especially this past year. We've seen that a lot with hospitality, food and beverage industry businesses. Banks have been wanting to get them into a more comfortable loan structure, and the borrower has also wanted that. And so we've done a lot of 504 loan refinances of same institution debt. And some of the times it includes cash out. And so cash out can be up to 20% of the value of the property can come out as cash. And that's really helped during these times to provide additional working capital. The parenthetical note there, as I mentioned, the 504 policies are constantly changing every year. There's usually some updates or some changes. New, the standard operating procedures typically kind of revamped every few years. And so there are some additional finalized policies that are anticipated to come through by the end of this month. The guidelines have already been issued, but the final policy has not. And so for anyone listening in on this webinar, wanted to share with you what may be coming through the pipeline in the next month for benefiting the refi program. Kind of the three major things there are that there is the potential for 504s to refinance government guaranteed loans. So prior, we weren't able to refinance 7A loans with 504. We would be able to do that. Same thing with USDA loans. Also, usually, if refinancing long-term debt, that debt has to have been on the books for at least 2 years. That 2-year requirement is going to be decreased to 6 months, or that's the proposed guidelines anyways that have yet to become finalized policy. So a loan that has been on the books just over 6 months will be eligible to be refinanced if the final policy follows the guidelines issued. And the third bullet, the third major one that is hopefully coming through by the end of the month is eliminating the requirement that debt needs to be current for 1 year prior to the application. So this was a big issue with a lot of the refis that we were looking at for all the loans that were on deferment this past year. And the vast majority of loans were on deferment so that borrowers could have a little bit of a reprise from P&I payments during these tough times. That will be done away with. So back to the benefits to the bank. The low 504 rate blended with the bank's rate helps them compete on deals. So maybe if a borrower is looking at some other lenders, but they're only able to do it conventionally, 504 rate typically will help the bank, BCC in this case, be more competitive on their rates. And we know BCC typically is already competitive enough on their rates, but this just helps them a little bit more. 504 Capital handles all the SBA processing. So the CDC benefit with the 504 program as compared to the 7A is that the CDC is working with the SBA. Borrower's not working directly with the SBA. The bank is not working directly with the SBA. You're able to lean on our expertise and our familiarity and connection with the SBA to get this processed faster and as efficiently as possible. It still is working with the SBA, and so there is still patience required, but a big part of our job, as Chris and I see it, is to manage your expectations up front. To get the loan process through requires diligence, being on top of it. We'll work with you, ensure that all of the documentation needed is getting into them in a timely manner so that we don't lose any time. And also giving you updates as to, every week we get an update from the SBA telling us what their processing time is. And so relaying that to you, especially if you're signing if you have or are about to sign a purchase contract, you need to know if you're able to make that settlement date or not. And so that's a big part of the value that a CDC provides. Also, from a bank's beneficial standpoint, as opposed to a 7A, on the 504, the bank is just left with a conventional first seat of trust, so they don't have to work with the SBA in a workout scenario, which could benefit the borrower in that there's not going to be delayed back and forth between the bank and the SBA. You have the two separate loans, and they'll be worked out, compartmentalized. They won't be intertwined. And then the last bullet there is, I've already mentioned, there's the SBA has experienced extremely high demand. I'm sure everyone's familiar with PPP, that deployed the most money SBA has ever deployed in a single year by far. I think the most money in that 1 year, they deployed more money than they do in a decade. So it really pulled on the resources of SBA, and it affected the resources that they have available for their 7A and 504 programs. So they're working to bounce back from that, still bouncing back from that. We're slowly starting to see their processing times kind of come back down. They're not what they typically are, but hopefully in the next few months, we'll see those getting back to pre-COVID turn times. All right, next slide, please. And we've already gone over this, so we'll keep going. Thank you. So just generally, the terms of the 504 loan on real estate, we can do 20 or 25-year terms. And so on the appraisals, the appraiser will come back and state on the appraisal what the remaining useful life of that property is. As long as it's over 20 or 25 years, you can take advantage of those terms. Machinery and equipment has to be useful life of at least 10 years. And then you'd have a matching 10-year term, fully amortized. Again, no balloon payments on these. Okay, next slide, please. And just quickly, the process here. So usually the bank is identifying the borrower. Usually the borrower is interacting with the bank that they're working with, either a bank that holds their loan currently that they're looking to refi, or a bank that they have their business accounts with and they're looking to acquire the building that they've been leasing, something like that. The bank would then bring us in, VCC would bring us in, is how we've worked with them in the past. And we would work with VCC on setting up the structure, making sure that the borrower understands all the fees involved. Both VCC and 504 Capital understand the sources and uses breakdown. And once we kind of have agreed upon that, then VCC will work on their internal approval. 504 Capital will work on the SBA's internal approval. And then once we get those, then we'll work on closing. We'll order the appraisals, we'll order the environmentals. Now, given that the SBA processing time has created some delays specifically on acquisitions, what we have seen is the borrowers need to go ahead and order those appraisals because appraisals have been delayed on turnaround time during this COVID era as well. And so that can occur. Borrower can pay out of pocket to go ahead and move forward with the appraisal and the environmental. Either way, both the bank's loan, VCC's loan, and 504's loan will be working towards close. 9 times out of 10, the bank will close their loan, and then you'll have a second closing of 504. So the bank will close their loan, and in that scenario where it's 50-40-10 split of the breakdown of the project costs, the bank finances 90%, and then they'll do that. They'll only close and finance 90% after they know that the SBA has the approval issued. Once they close and fund, then we will work with the borrower to get our closing done, to then to get the guarantee in place, package that in the form of a debenture, which is then sold into a market. That debenture, once it funds, then goes down to pay the to pay BCC in this scenario down to a 50% loan to value. And so the borrower is left with the bank's first deed of trust loan, 504 Capital's second deed of trust loan, and they will have only put in 10% into that project. And it's one and done. The 504 component to that will be fixed for 25 years, so you never have to touch it again if you don't want to. And right now it's fixed at historic low rates, so there would likely be no reason to touch it or refinance it unless if you were selling the building. And so the 504 reporting to the SBA is done by the CDC, and we'll work directly with the borrower on that for ongoing processing. All right, next slide, please. And so that's 504 lending, kind of in a nutshell. If you have any questions, I know that we'd love to hear from you. Joey, I think we're gonna enter into the Q&A section of this, but regardless, this is Chris and my contact information. We'd love to hear from you if you have any questions, and work with you and BCC on any of your 504 financing needs.
Zachary and Chris, thank you all so much for the presentation, and thank you for actually giving me a few highlights about the 504 program that I didn't realize. And yes, we're going to move into the Q&A section of the program. So we have a couple that are in the chat, and please, I apologize, a couple that are in the Q&A. Please don't add any to the chat. So the first one is the 504 loan only applicable to a business that has a building or collateral? With so many businesses having to restructure, some will not be going back into a brick and mortar.
Yes, so the vast majority of 504 is for commercial real estate. There has to be a fixed asset collateralizing the 504 piece. And so it's directly related to financing that fixed asset. So if a business, and understandably so, hit with the impacts of COVID, a lot of retail businesses, as you're probably referring to, are leaving their brick and mortar locations to maybe do remote work. That would be better suited for the SBA's 7A program, which I know BCC does as well. And so, yeah, the 504, if it's not commercial real estate or heavy equipment, it's going to be a 7A loan.
So to further answer Zachary's question, just like he said, that although the 504 program may not work, there are other programs. So definitely touch bases with your VCC lender, and we'll ask them additional questions and see if we're able to help. The next question: what can be counted towards equity contribution for refinancing activity? I apologize, hang on. Contribution for no growth refinancing activity.
So you may take this one, Zachary?
Sure.
So I think the question is, yeah, on a refi, oftentimes the equity is just going to be the equity that's already in the building. So for example, if we would get a new appraisal, so if the building's worth $500,000 and the refinance is only $300,000, well, then there's plenty of equity already there. If we ran into a situation where that wasn't the case and there wasn't that inherent 10% or 15%, whatever's applicable equity, then in order to refinance, the loan would have to be paid down a bit to get us into those appropriate loan to value limits. But I would say most of our loans we refinance, because they have to be seasoned a little bit, we're already there on the equity. I guess to Zachary's point, with our refinance rules changing to where the loan only has to be seasoned 6 months, maybe we could run into an issue there. But typically, I'm sorry, I'm sort of thinking out loud here. If we're refinancing a conventional loan, then the bank probably required more than the equity we would need anyway. So typically it's already, the equity's already there.
Okay, thanks guys. The next question, and this one may feel a little loaded, but I can't wait to hear the answer. How long does it typically take to close a commercial real estate loan with 504 funding?
So I'll Chris, you want me to take that?
Sure.
Yeah. So again, I'll put the disclaimer that we're in unprecedented times in every regard. I mean, that can be said for any answer given in the past year, but the SBA is no exception. And from the time to give a direct answer, which is tough because each deal is different. I would say from the time that the CDC gets a complete application to the time that we get approval from the SBA, safely around 2 months right now. With that approval, the bank can close. And that's typically what we've been doing. I say around 2 months, but that's if no issues come through on the appraisal, that's if no issues come through on the environmental. There's a lot of components to a commercial real estate closing that are outside of the SBA. But with that SBA approval, that's what the bank is waiting for their closing. And so that's typically on the deals that are time frame tight, the acquisition deals where, it's a seller's market right now. Seller's not going to want to wait 3 months, 4 months to get to the closing table. The borrower is going to have to pay out of pocket to get the appraisal. They're going to have to pay out of pocket to get the environmental, get all that started before they even get an approval if they want to take advantage of the 504 program. And the reason that they are doing this is because of such favorable rates, because they have so little to put down. And so the majority of our acquisitions right now, that's what's being required. From the time the approval is received, hopefully the bank can then close. And then our takeout, there's not as much of a rush on that because the property's already been purchased in this scenario. And then we can work with the borrower on doing our closing. From our closing, it takes about 2 months for that debenture to fund, regardless of pre-COVID era or post-COVID era. That's the time frame. It's about 2 months, and then our takeout occurs. Now, as I mentioned, that's a lot more. There's a lot more time sensitivity for acquisitions. For the refis, there's a lot more grace. If you're refinancing a different lender than say VCC is taking out a loan from another lender, typically that lender is going to be okay with providing an extension or whatever, knowing that you're working with another bank to take them out. Or if it's same institution debt, if VCC is refinancing their own loan that you have with them, then obviously the amount of time it takes is the amount of time it takes. So yeah, it is a loaded question, therefore loaded answer. Right now with processing with the SBA, it is, you can tell that they are doing their best with the limited resources that they have. They're working to hire more folks, get more folks trained, but right now the processing time is just requires patience. And so the communication is vital for this, especially with the seller, if it's an acquisition. Chris, do you have anything you want to add to that?
Yeah, I'll load it up even more. So on the optimistic side here, because Zachary, you're exactly right. I will say that in the past just few weeks, we have seen the average turnaround time slightly start to come down, which really we hadn't seen in close to a year, right, Zachary? Now you're muted, but it was really about last September where all of a sudden the time it took us to get an approval from the SBA went up like 500% on how long it took. And then it didn't really get much better. It was getting worse in that period of time. But just recently, we've seen some improvement. We've also just recently hired some additional support internally just to try to do everything we can at 504 Capital. I think one of the most important things of what Zachary was just saying, I mean, the fact of the matter is the turnaround times are slow right now. So right, it's all about communication up front. We communicate and then communication to the seller. But what we do at 504 Capital, it's not that dissimilar from how the bank approaches the deal. So I think if you read about the 504 program, it kind of sounds like at 504 Capital, we just ask you for a list of documents, and then as you send them, we upload them to the SBA, and then the SBA does the work and makes their decision. Well, we physically have to collect everything on the front end and write up, a credit memo or a credit memorandum that we then send in to the SBA. And so I want to make that point because yes, there are plenty of delays on the SBA side, but as a client, as a borrower, what you can do, or as a banker who's also sort of our client, right, is, we do our very best to send out comprehensive lists of everything we're going to need so that we don't have to come back to you 50 times. What we tend to see is we have the conversation of, like Zachary just had, of how long it's going to take. We send out a list and then we don't hear anything for 2 weeks. And then we ask for A, B, and C, and we get A, and then we might get D, which we didn't need. And then, so by the time we get what we need to write it up and submit it, we're already 4 weeks in. And so that's where the time, the time frame can really stretch out. So what I guess my point would be is, if this is the right fit for you, or if bankers on the line for a client, just making sure that everybody's ready to go the second that contract is signed, and not sign the contract that gives you 90 days, but then we don't really get started for 5 weeks, because now we're already way behind there. So that's my 2 cents.
Okay, guys, and thank you very much. And I'm going to piggyback on what they both said. And sometimes the timeline is dependent upon the borrower and getting the requested information in a timely manner. That helps the process keep moving. With that, we do have a few more questions in the Q&A. What fees will I incur as a business owner using the 504 funding rather than a conventional loan?
So there are fixed fees, and then there are fees that are a percentage of the 504 loan amount. And so as the loan amount goes up, the total percentage of that fee would then drop, because, like I said, you have those fixed fees. So on $1 million project, you're looking at about 3.5% total fees. Those are being just on the 504 loan. That's not on the total project. That's on a $1 million project, 504 is financing 400,000 of that. You will have between, I would say, 3 and 3.5% of fees, and those are financed into the project cost. Chris, does that sound about right?
Yep, that's right. The majority of the fees and costs associated with the program are going to be built into the loan. You don't even have the option of paying them out of pocket. Where you do have to come a little bit out of pocket on the 504 side is what I would call the transactional closing costs. So when we come to that second closing that Zachary mentioned, recording and title work and things that we would be able to give you a pretty good estimate of when we started the process here. And that's a great point. So if you're going to pay, $12,000, $15,000 built into your loan on a $1 million project, the 504 program is not beneficial to someone whose plan is to buy a building and then sell it a year later or 2 years later. So once you start getting into the 6, 7, 8 year time frame of holding, you will absolutely realize, more than enough of that interest savings to cover the fees built in. But we do have that conversation on the front end too. It's a long-term hold program, and that's where you more than recoup any fees built in.
Okay, great, thank you. And another question that hit the Q&A, and I was able to answer, but I would like to give the question to the entire group. It says, do you have to have a prior relationship with VCC to move forward? And the answer is absolutely not. We are definitely looking for new clients, so reach out to us. The next question, what entity will I make the payment on my 504 portion of the loan? Your company or a different company?
It's a great question. With the 504 program, you end up with 2 loan payments. So if we work with VCC, you would make your monthly payment to VCC. On the SBA's piece, the 504 loan, all SBA loans are actually handled by the centralized servicing agent, which is Wells Fargo. And so what you would see is your SBA loan payment for that 40% would be automatically drafted once a month. It would show it's going to Wells Fargo, but that's just the mechanism of how the SBA collects the payments there. They essentially, Wells Fargo collects it and then distributes the piece to our company and then the piece to the SBA. So that's what you would see. And the 504 piece has to be set up on an auto draft.
Okay, great, thank you. All right, so the Q&A is empty, but I have a few questions that I have stored up for you guys. How long do you have to be in business in order to qualify for a 504 loan?
So there is no, as I guess from our initial example that we gave, that was a true startup, no business at all, no years in business at all. If you haven't been generating revenue for 2 years, you're considered a new business. And so that additional 5% equity piece is what's required. And that's why the climbing gym didn't get 90%, they got 85%. So there's no requirement of how long you have to be in business. I think everyone probably understands that it's always tougher for a startup in going, working with the bank and the SBA, but it's certainly not impossible if it's a strong project.
Okay, great. Thank you very much. All right, another question. Can you qualify for a 504 loan if you've received emergency relief from COVID? And I'm assuming that they mean either PPP or the EIDL loan.
Yes, you can. And there is one of the things I didn't mention is there is a cap on the amount of exposure the SBA can have to a borrower through the 504 program. It's 5 million. And that number, any PPP money or any EIDL money that came to a borrower does not affect that cap. It doesn't go against it. So yes, you can have those loans and it doesn't impact your 504 application.
Okay, and I'm going to ask again, if you have additional questions, please put them in the Q&A, but I just happen to have another question for you all. Is there a minimum credit score needed for a 504 loan? And do you all review personal credit in a request for a 504 loan?
We do review personal credit. I'll have to, Zachary, correct me if I'm wrong. I don't know that there's an absolute minimum. What I would say is if there are existing credit issues, if there are current delinquent taxes and delinquent payments and negative items currently on your credit report, it's going to be much more difficult to explain to the bank and to the SBA. If a credit score is maybe not, in the 700s because of a medical bill in the past that's been resolved, or maybe a divorce or something like that, but there's nothing currently, I guess, negative, it's just being rebuilt, then that's easier to explain to everybody. I don't know that there's an absolute drop dead minimum. Zachary, is that what you would say?
So it's the same algorithm that the SBA uses for their 7A, and we don't know. I don't think that there's a threshold for the number, because they're not looking at Experian, they're not looking at any of the 3 bureaus. It's an algorithm that the SBA has created, which weighs all of the considerations. And as Chris mentioned, the biggest thing is that if you have any outstanding collections or anything that a lender is still has moved in collection or anything like that, that will likely need to be cleared up for a little bit of time before you proceed with an SBA guarantee request. And if you have ever lost, if the federal government has ever sustained a loss from either the borrowing entity or the guarantor, then you are not eligible for a government guaranteed loan. And so that could come in the form of, a government guaranteed housing loan or student loan that had been charged off where the government sustained a loss. So good question.
Thank you all. And I believe I have the answer for this one, but I'll share it with the entire group. I'm looking to expand my business and I need new equipment and of course, employees. What is the best route to go for both? And I'm going to say, meet with a VCC loan officer to discuss your entire project so that we will understand what you're trying to accomplish. And there are 3 in addition to myself that would be really happy to speak to you about it. The next question, what are the steps required for a business with less than 3 years of creation in order to qualify for a loan? So they're up and running, but they've been running for less than 3 years. What are some of the qualifications that you all would look for?
Yeah, I think as Chris mentioned, I mean, even a business that's a startup is eligible. I think if you are yet to generate a profit, that's going to be hard to justify, and you'll need to justify it. And your assumptions behind any projections that you provide will certainly be important. And I would say more than, so the SBA's requirement is that you at least generate enough cash to service the proposed debt in your projections, if not historically. Historically, ideally, and they're kind of cracking down on even projection-based deals. What Chris and I have seen even more so, especially in the past year, is lenders obviously are tightening down on their credit criteria. And so historically, if pre-COVID you weren't showing profitability, obviously COVID usually has an adverse impact, though some industries have benefited from it. So really, as Joey had talked about, having the conversation early with your VCC lender, they can get us involved and we can have a conversation together, the 3 of us, to figure out what respectively can our credit teams get comfortable with, what can the SBA get comfortable with. Each deal is unique, but if it's a projection-based deal, meaning that you only can service the proposed debt through projections, it's going to be tough to get behind. It's going to be tough for the SBA to get behind. You're really going to have to back your assumptions as to how you will be able to service that debt. And you don't want to take on debt that you wouldn't be able to service anyways. Even if the SBA said that it would be okay to do, if you don't feel confident that you can service it, you're only doing yourself a disservice. And we wouldn't want to put you in that position. And I know VCC wouldn't either.
Okay.
No, we're against Joey, let me say one thing on that. And I know we're up against the clock. If, plan ahead the best you can if you think you might be looking to buy a building or looking for an expansion loan in the future. And what I mean by that is have those conversations early on with your CPA. Nobody likes to pay taxes. And so we do see quite a few tax returns where, the net income was $1, or not really, but it's funny how it worked out to where the expenses were exactly what the revenue was. But if you're thinking in the next couple of years, you might be in a position where you want to purchase a $500,000 building or have a big expansion loan or something like that. Have the conversation with your CPA so that your financials are supporting what you're truly doing. And so that you're not having to be in that situation of only relying on projections when deep down you could afford the loan, your tax returns just don't show it.
That is some super advice, Chris. Please, if you remember anything from today, that is super advice. And I would also like to thank Zachary and Chris again for participating and actually sharing with us today. And as I mentioned at the top of our discussion, a follow-up email will be sent to everyone who registered for this event next week, and it will include a link with the recording of this webinar and additional resources. If you'd like to contact our team or learn more about lending at VCC, please visit our website at www.vacommunitycapital.org. Thank you for attending, and this concludes our webinar. Thank you.